Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different than the news media in America. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is, I know it was Job that said so faithfully, the Lord giveth and the Lord taketh away, but blessed be the name of the Lord. And this week, the stock market took a bite out of those 2023 returns for most investors after posting nearly a 5% loss for the week, which we'll get into a little bit more detail in a few minutes. But the stock sell-off this week was led by the second largest bank failure ever, SVB, which was formerly known as Silicon Valley Bank. Now, this is the first bank failure since October of 2020 when Almena State Bank in Kansas failed. And I'll do more on this point on point number 2. However, this sparked fear of contagion in the banking and financial services sector, with most bank stocks selling off sharply, creating a down dip for the week. The market was actually trading positive on Friday until news of SVB came out, partly because the February jobs report was released showing employers added 311,000 jobs for the month, which was a solid monthly number. Less than January, where we had a blowout number of 500,000, but still a very, very good number. One encouraging note in this month's job report was the fact that we saw a pool of entrants seeking work, and that has led to a higher unemployment rate, which popped up to 3.6%. You had more workers coming into the workforce. That's good. We're back to where we were pre-COVID now with the amount of workers in the workforce. In addition, we saw wage growth slowing, and a big factor can cool wage growth is so many new entrants coming into the workforce. All said, this was a good signal in regards to the markets because it gives the Federal Reserve some clarity that their rate increases are having their desired effect. Now, first, you're starting to see some things breaking in the economy. That's what they want to see. Even though that sounds bad, they want to break some things in the economy. And you just only need to see the 2 banks that were taken out this last week. And you're starting to see slower wage growth, which should help cool the inflation number. Now, for the week, we saw the S&P 500, which tracks our growth and our growth and income stocks, when taken together, not independently, but when taken together, that dropped 4.55%. We saw the Russell 2000, which is our proxy for more aggressive growth stocks, that dropped 8% for the week, aggressive growth. And finally, the MSCI EFA, which tracks international stocks, was down 3.15% for the week, the winner again. Stick around for point number 3, where I'll specifically talk about the markets this year after a rough week. Now, point number 2. I remember during 2008 and the aftermath that came out of that year, I would every Friday check the FDIC failed bank list. Now, at that time, there was 3 to 4 banks failing every week. And I was just curious at that time to see who was on the list, if any banks locally were in the list, and more specifically, if my employer at the time was going to be the one purchasing any of those failed bank assets. Well, at some point, I stopped checking the list because it became pretty dormant. For example, in 2021 and 2022, there wasn't a single bank failure in the entire country. During the year of the pandemic, we only saw 4 banks fail. And that streak changed Friday, the no bank failures for the last 2 years, when the second largest bank ever, as mentioned above, failed. Now, why did it fail? And does it sound an alarm for the entire banking system, like the markets would have you think from last week's results? Well, the reason they failed is simple: capital. One thing I've told many clients about why their banks are not paying interest is this. You wouldn't either if you were a bank CEO and you had all these deposits coming in and you couldn't lend them all out. Let's run through a quick example. Your bank brings in $1 million in deposits. They need to either be lending that money out, or if there's no lending demand for those dollars, they can invest them into investments, usually very safe bonds. The more deposits and the less loan demand, Jerome Powell and his high interest rates and slowing economy, then the more deposits that need to be put into those safer bond investments. Now, when bonds are on a bank balance sheet, they're held in one of 2 ways. Either ones that they sell to meet liquidity requirements from their depositors. When their depositors start taking money out, they sell those bonds to get the cash back. And those are coded on their balance sheet as available for sale, or AFS for short. And those are marked to the market, meaning as their value changes, so does the value on their balance sheet. Then they have bonds they intend to hold to maturity. They don't intend to sell these bonds. Those bonds get accounted for at what their value is when bought and what they'll mature at, and they don't get marked to the market. These are called held to maturities, or HTM assets. Now, here's the thing about bonds. If you buy them for a $10,000 par value, that is what they'll mature at. However, if interest rates go higher, the value of your bond drops below that $10,000 par value. And if rates go up really, really fast and you hold 10-year, 20-year, 30-year bonds, the value depreciation or deterioration of those bonds from a current price perspective can be pretty dramatic. Again, you get the $10,000 back at maturity, but the current value of your bond could drop to $9,000 to $8,000, depending on how long that bond was and the pace of those rate increases. Well, what happened last year? Historic rate increases. Worst bond market ever since 1842, according to the Wall Street Journal. Many of these bank bonds got clobbered, but if they were coded as held to maturity, because those don't have to be marked to the market, you wouldn't have seen the losses on the bank's balance sheets unless, key word here, the bank had a run, a lot of deposits leaving, and they were forced to sell those held to maturity assets they didn't think they were going to need to sell. And here's the thing. If you sell just one held to maturity asset, you have to reprice the entire held to maturity portfolio, therefore forcing you large losses almost immediately. SVB's held to maturity book was about $98.7 billion, and their average duration was 6.2 years. Their held to maturity book losses were around $16 billion on their portfolio, and their common equity was only $11.8 billion. There's a word for that when your losses are more than your equity. That word is insolvent. Yikes! Thus, the problem was not that the bank's business model was wrong, nor any systematic problem in the financial sector, unless all banks were this poor at managing their bond portfolio. But SVB was the former Silicon Valley Bank, and they bank many of the tech companies and employees in California on the West Coast. And they had many depositors with over $250,000 in their bank account, which is the current FDIC insurance limits. Once they heard a whiff of trouble, many of those companies immediately ran to pull their money out of SVB, and that created a run that forced them to pull from their bond portfolio, which forced the losses. Hence, the FDIC insurance came in and took them over. Their regulators forced them to shut down. At this point, there's no buyer, so SVB will be sold off. It's different business units. It's wealth management business. It's trading business. It's commercial lending business. And whatever assets can be recovered will be paid to those depositors with greater than $250,000 in FDIC assets. Point number 3. Let's do a quick recap on the markets. First, here's the plain and vanilla facts. The stock market over the last 30 years, which has included some dramatic drops like 2001, 2002, 2003, not necessarily 2003, but that whole cycle. 2008 was, of course, really bad. 2020, many of you have a fresh memory of that. But it still averaged around 10% a year. 80% of those years, the stock market was positive, or said another way, 8 out of 10 years, the stock market had a positive result. 20% of the time, over the last 30 years, the stock market was negative, or said another way, 2 out of every 10 years, the stock market had a negative, a bad return. However, this is interesting. On a daily basis, 53 to 55% of the days, trading days, are positive. Think about that for a second. 80% of the years are positive, but only 53 to 55% of actual trading days are positive. This tells you there are some big swings in there, and it doesn't do any good to watch this stuff daily. So don't do it. You'll just stress yourself out. That is why you have somebody like us. Trust me, we're watching it daily, and that's enough for the both of us. However, to give you a primer on the year-to-date returns for the markets, let's look at this chart. The chart shows that the S&P 500 is still positive 0.58% on the year, barely hanging on to a gain. And remember, the S&P 500 tracks growth in income, but only when taken together, not separately. The Russell 2000, which again is our proxy for aggressive growth, is still hanging on to a 1.04% gain on the year. And the MSCI EAFE, which tracks our international stocks. And many of you remember, I've been saying that's been the winner many of these weeks. Winner on the downside, winner on the upside. That's still up 4.59% on the year. Point is, don't make emotional decisions. Stay focused on your time horizon. And if you're getting close to your goal or retirement, some of your funds should be allocated to safe or non-stock market correlated assets to reduce the volatility. Talk to your financial advisor to get specific advice. And point number 4. Last week, the Federal Reserve released their BEIGE book. Now, what is the BEIGE book? The BEIGE book is a report published by the Federal Reserve. It's published 8 times a year, and it outlines current economic conditions of the 12 Federal Reserve districts. In regards to the state of the U.S. economy, the consensus in this last report was that overall economic activity increased slightly so far in 2023. Of the 12 districts, 6 of them reported little to no change in economic activity since the last report, and 6 of them indicated economic activity had picked up at a modest pace. In regards to the labor markets, both wages and hirings increased at a modest to moderate pace in most districts, despite seeing some hiring freezes and scattered reports of layoffs here and there. In regards to inflation, probably the big one, inflation pressures remained widespread in every district, though some districts reported prices are starting to moderate. Just as we spoke about last week, remember, I told you if the case for a 0.5% rate hike were to be increased, which last week that CME Fed Watcher tool that we watch only had a 30% 50 basis point increase probability. But if it went higher, that would signal trouble for the markets. Well, as of today, the current probability is now 70% for a 0.5% rate hike. Probably another reason why we had such a terrible week last week. However, perhaps the 16th largest bank failure in the U.S. being taken over by the FDIC will have the effect of slowing down the Fed and get back to a 25% basis point rate hike, and some of the data we've seen in this Fed BEIGE book. The bond markets on Friday definitely gave signals that a 25 basis point rate hike is back on the table, but we'll see. And remember, their Fed meeting is March 22nd. Again, this is important because if the Federal Reserve goes back up to 50 basis points, they're admitting that they shouldn't have slowed down as much because they went down to a quarter. Going back up to 50 would be outside of the playbook of the historical norm for Fed. Normally it's raise, then lower, and go down on a hill or just completely stop. Going down and then coming back up has never been done. And as of right now, 70% probability. And again, that Fed BEIGE book that came out this week, that is a major thing that Jerome Powell, the Federal Reserve president, has said they watch. So important to see. We'll see how, again, this week's activities change those stats. If you have any questions about the 4 things we learned in the markets this week, you can go and schedule a meeting with any of our financial coaches or our financial advisors, and that link can be found in the comment section. Our financial coaches help you with baby steps 1, 2, or 3, help you get out of debt, stay out of debt, live on a budget, hold you accountable to those sort of things. Anything you need in regards to those baby steps, they're there to help you with. Our financial planners are there to help you with baby steps 4, 5, 6, and 7 so you can live and give like no one else. So please go to the comments to schedule a meeting if you need any help. As well as, would you do us a favor that we so appreciate? We appreciate when you hit the like button. The like button helps us with Google and YouTube's algorithms that push our content out to more people. And would you subscribe to our videos so that anytime we release new content, you're one of the first to see that new content that's being released. Thanks so much, and we'll look forward to seeing you